If you've ever watched the stock market suddenly plunge after a Federal Reserve announcement or skyrocket on the hint of a future rate cut, you've witnessed the single most powerful force in modern finance, the relationship between interest rates and stock prices. It can seem confusing, even magical. Why should a seemingly small change in a percentage point, decided by a committee of economists in Washington, cause trillions of dollars to move around the globe? The truth is, this relationship isn't magic. It's mechanical. Interest rates act like gravity on the stock market. When rates are low, gravity is weak, and stock valuations can float higher, sometimes to dizzying heights. When rates rise, gravity increases, pulling valuations back down to earth. Understanding this force is not just for economists, it's essential for every single investor. In this video, we're going to demystify this entire process. We'll break down the three fundamental channels through which interest rates directly influence stock prices. First, we'll explore the most direct channel, how rates affect the intrinsic value of a company through a concept called the discount rate. Second, we'll look at the competitive dynamic between stocks and bonds. And third, we'll examine the real-world impact of borrowing costs on corporate profits and the broader economy. By the end of this, you won't just know that the Fed moves markets, you'll understand exactly how and why it happens, giving you a huge edge in interpreting financial news. Let's start with the most important, yet least understood, concept, the discount rate. To understand a company's true value, investors don't just look at its profits today, they estimate the value of all its future profits. But money in the future is worth less than money in your hand today. This is the time value of money. To calculate what those future profits are worth in today's dollars, we use a discount rate to bring them back to the present. The most critical component of this discount rate is the so-called risk-free rate, which is essentially the yield on the 10-year U.S. Treasury note. When the Federal Reserve raises interest rates, the yield on these Treasury notes goes up. This means the risk-free rate has increased. Now here's the crucial part. If an investor can get a safe guaranteed return of 5% from a government bond, why would they take a big risk on a volatile stock for a similar or only slightly higher potential return? They wouldn't. To make stocks attractive again, their price must fall, which increases their potential future return. This is the valuation anchor that pulls down the entire market. This effect is magnified for growth stocks, companies like tech firms that promise most of their profits far in the future. When you discount those distant profits at a higher rate, their present value plummets. This is why the Nasdaq, which is packed with growth stocks, is often much more sensitive to interest rate changes than the Dow Jones. A pro tip for every investor: when you see the 10-year Treasury yield spiking quickly, you can almost guarantee that high-flying growth stocks are about to get hit hard. It's not a conspiracy, it's just financial math. The market is rationally repricing the value of future cash flows. The second major channel is the simple concept of competition. Think of the financial universe as a giant marketplace where capital flows to the best perceived risk-reward opportunity. On one side of the aisle, you have stocks, which are higher risk, higher potential reward assets. On the other side, you have bonds, which are low risk, lower reward assets. Interest rates are the price of money, and they directly determine the reward from the bond aisle. When interest rates are near zero, bonds pay you nothing. They are a boring, losing investment after inflation. In this environment, investors have no choice but to pile into stocks to seek any meaningful return. This forces money into the market and pushes stock prices higher. This was the entire story of the post-2008 financial crisis era. But when the Federal Reserve starts aggressively raising rates, bonds suddenly become attractive again. A safe, government-gated certificate of deposit or a Treasury bond starts offering a guaranteed 5 or 6% return. That's a compelling alternative to taking a risk on a stock that might go down 20%. This dynamic causes a massive rotation of capital. Money flows out of the risky stock market and into the safer bond market. This selling pressure in stocks naturally causes prices to fall. It's not that companies have suddenly become terrible businesses overnight. It's that the opportunity cost of owning them has gone up. The alternative to owning stocks has become much more attractive. This is why you'll often hear financial commentators say there is no alternative to stocks, or its acronym TINA, when rates are low, and then talk about the great rotation into bonds when rates rise. The third channel is the most tangible, the direct impact on corporate profits and the real economy. Companies don't operate in a vacuum, they run on debt. They borrow money to fund expansion, build new factories, hire employees, conduct research and development, and manage their daily cash flow. When interest rates are low, this debt is cheap. It's easy to invest in growth, and the interest payments on existing debt are manageable, which flows directly to the company's bottom line as higher earnings. But when the Fed raises rates, the cost of corporate borrowing skyrockets. A company looking to build a new factory might delay or cancel the project because the loan is now too expensive. This slows down capital expenditure, which can slow the entire economy. Furthermore, the interest payments on their variable rate debt increase, which eats directly into their profits. Lower profits, of course, lead to lower stock prices. This effect then ripples out to the consumer. Think about mortgage rates and car loans. When rates are low, people can afford to buy bigger houses and new cars, which boosts the economy and the earnings of home builders and automakers. When rates rise, a potential homebuyer gets priced out of the market because their monthly mortgage payment is now hundreds of dollars higher. This cools the housing market, which impacts construction jobs, appliance sales, and furniture stores. The Fed's entire goal in raising rates is to deliberately slow down an overheating economy to combat inflation. They are essentially trying to tame the economy by making money more expensive, and a side effect of that successful policy is almost always a slowdown in corporate profit growth and, consequently, downward pressure on the stock market. It's a delicate, and often painful, balancing act. In conclusion, the relationship is clear and powerful. Higher interest rates increase the discount rate, lowering the present value of future earnings, especially for growth stocks. They make bonds more competitive, drawing money away from the stock market. And they increase borrowing costs for companies and consumers, slowing economic growth and squeezing corporate profits. The next time you see a Fed announcement, you'll understand the three-engine mechanism firing behind the market's move. Before we finish, a critical disclaimer: I am not a licensed financial advisor. This video is for educational purposes only and is not investment advice. The stock market is influenced by a multitude of factors, and while interest rates are a primary driver, they are not the only one. All investing involves risk, including the loss of principal. You should conduct your own research and consult with a qualified financial professional before making any investment decisions. Your call to action is this: the next time the Federal Reserve has a meeting, don't just watch the headline number for the rate decision. Go to a financial website and pull up a chart of the 10-year Treasury yield. Then, watch how the S&P 500 and the Nasdaq react in real time. You will see the direct correlation we discussed play out right before your eyes, turning abstract theory into concrete understanding. If this guide clarified one of the most critical concepts in finance for you, please hit that like button and subscribe for more content that makes you a smarter investor. Thanks for watching.